What's up? It's Rowan here from Artist Mind Education with the weekly HSC Economics Stats Update. In this episode, I'm going to be doing a deep dive on the recent inflation data that ABS dropped, how you can utilize it as well to analyze the effectiveness of fiscal and monetary policy. If you're dialing in for the first time, in these episodes, I summarize the key stats and headlines from around the domestic and global economy that you need to know for the HSC Economic course so you can unlock that Band 6 in economics. So let's dive right in. The ABS just released their quarterly data for September for CPI and inflation. And there's really good news here, okay? The good news is the headline rate of inflation is now at 2.8%. Now that's a big drop from 3.8% in the prior data, right? So it's a 1% reduction, which is really fantastic. Now note, I did say a really important word though, which is headline, okay? Now headline basically is not going to be the best measure of the true rate of inflation over the long term that's sitting in the economy. Okay, it's going to get impacted by more shorter term, both high increases of inflation, also reductions in prices. So what the RBA particularly looks at here is the underlying rate of inflation, or the trimmed mean. So what has happened with that? Well, the good news here is that's also a lot lower as well. So the trimmed mean was 4% and it is now 3.5%. So headline has gone down by 1%, right, from 3.8 in June to 2.8 in September, and the trimmed is also going the right way. Now, the positive here is with headline, it's actually in the target. Our target bracket is 2 to 3% that the RBA sets, and so we can see that headline is moving in the right direction. Unfortunately, we can still see that the trimmed mean, or the underlying, is still well above at 3.5%. Now, note, the RBA is not going to be surprised by this. They have said that in their own estimates in terms of forecasting, they don't expect the underlying, which is the real measure that they look at, to get into the inflation target bracket by mid next year. So in other words, this is movement in the right direction, and arguably, it's accelerated a little bit of that reduction, but we've still got more work to do from an RBA perspective. Now, let's look at a couple of data points here that might explain why this has occurred. So this is a Sydney Morning Herald article with some really fantastic sort of insights and just visualizations. The first thing, right, in terms of really highlighting one of the reasons is that ultimately, okay, petrol prices have really played a role in reducing and placing downward pressure on the headline rate of inflation. So they don't factor into underlying, but for headline, in explaining that 1% reduction, petrol prices have fallen 6.2%, right, over the last year thanks to global demand falling. That's about 13 cents cheaper per litre at the petrol station. So firstly, that's one reason why. Now, the second reason why is also lower electricity prices are dimming inflation. Now note, this has more of an impact once again on headline, not underlying. So it's why, the underlying hasn't shifted as much, right? Whereas the headline has. And this has largely been because of significant government expenditure, okay? In terms of, government electricity rebates to really support, families with cost of living relief. So this goes to really analysing the effectiveness, right, of cost of living relief, particularly if we think about these energy, rebates that the federal government as well as state have implemented. And so what they're highlighting here is this is what it would have been, okay, and this is what it is, 87.7 in terms of the index, electricity index, compared to 115. You can see that really sharp drop that's occurred as a result, which is, I think, really a real highlight, okay? So these overall utility prices are 7.6% down, right, as a result, okay? So I think there are a couple of reasons why. Now, on the flip side, okay, the argument though, okay, is that, there is still increases in service costs, right? So where inflation's remaining stickier, and this goes to more of underlying, okay, because services are also ultimately going to be driven by wage costs and increasing wage costs. We can see that a lot of the inflation that's still existing in the economy is coming from services, right? And you can see service inflation by category. Obviously, insurance very high, and we know rent, okay. But then if you look at all of the rest of these ultimately are ones that are very high in human labor costs, right? That are going to be passing on costs as a result of whether or not it's minimum wage increases, right? Through the Fair Work decision that came through in the middle of the year in July, right, which starts to sort of flow through in this data in this quarter, or just generally, the fact that we've got, low unemployment in the Australian market and therefore, low excess demand that will place some upward pressure on wages. So how can we utilize this a little bit more to analyze the effectiveness of policy? Okay, well, The Guardian and Greg Jericho here has a couple of great things to say about this. So first of all, right, annual inflation, okay, and this is all group CPI, this is headline, okay, is the lowest in 4 years annual inflation, okay? Which I think is really significant in terms of, what they were really highlighting. Now, I think you can see whether or not, all groups or CPI trim mean, either way, we're seeing really a movement in the right direction. That's fantastic. The other thing that we want to be highlighting here is this is also occurring, at the time when unemployment is at 4.1%. So we've managed to get a headline into the bracket, underlying is coming down, right, into where we expect it to be, and yet unemployment is still at 4.1%. We've always been told the Phillips curve, right, says that there is a trade-off. There is a conflict between, low unemployment and low inflation, and when inflation is going to start to fall, unemployment should start to rise. And sure, we've seen slight increases in unemployment, right, but it's still at historical low levels. And so in other words, I think this could be really, highlighting a real strength of the current macro policy mix, in that it's simultaneously, and particularly monetary policy, but fiscal policy certainly supporting from a labour market perspective as well. It's supporting both, the downward pressure that needs to be happening on inflation while maintaining, that strong, unemployment outcomes, which for the RBA, taking on a dual policy goal objective in terms of prioritisation of inflation and unemployment and full employment of labour market is a real positive thing. Now, additionally, what we could argue for fiscal policy specifically, is that ultimately, and this is what Greg Jerick has to say, the electricity prices would have fallen over the past year by 2.7%, or instead of 15.8%, So given electricity combined or contributed to a nearly 0.4% fall in inflation over the past year, if you cancel that out, overall CPI growth would have been closer to 3.2%. So in other words, what he's saying is for the headline, yes, we got it to 2.8, right, from 3.8. But if we weren't to factor in all of the government rebates, the cost of living measures around electricity, it would have actually produced, a headline inflation result closer to 3.2%. In other words, above the target. So we can see how, both the RBA and fiscal policy, right, both at a federal and a state level, is playing a role here in terms of that macro policy mix to try to get inflation down. Now, of course, that's headline, not underlying, but it's still a relevant point that you can make. Now, his point as well is very similar, right, to the Sydney Morning Herald article in terms of what are the drivers that are causing this. And the real challenge, is that at the end of the day, service price growth is continuing to occur, and it usually follows that wage growth, right? So you've seen minimum wages go up, great, across the economy. We're seeing this quarter data come through as well, We've had strong wage growth, right? We're now seeing that flow through into services. And so, what this really highlights at some level is just the tension, right, that can occur between, we obviously need stronger wage growth because we're getting eroding, income levels in terms of real income because of, high inflation, but at the same time, there is a relationship between wage growth and inflationary pressure through to services, and that's the trade-off that needs to happen. Now, the final piece of news this week, and this is one that's for you as a student going to be very relevant, is that there's a likely outcome here in terms of the Labor government proposing to make changes to the higher education loan program HELP, right, previously known as HECS, which is basically what you would use if you go to universities and have to pay up front, right? The government basically provides you a loan. This is designed again to deal with cost of living relief, and this is, I think, a smart initiative designed to try to provide some of that, but also to do so in a way that does not create inflationary pressure, And so, again, whether or not there are other, from a bigger picture policy point of view, right, there are other criticisms, and I think you could argue it's an election sort of, initiative, right, with an impending election coming up, and that might, bring into some of the sort of limitations. I think what the core idea here is basically about is trying to increase the threshold at which someone, needs to start repaying their help debt. So at the moment it's $54,500 roughly. It's going to move up to $67,000. So what that does is it means that as a result, while you're, earning that income, you're straight out of university, you're going to have more time to not have to pay that. Therefore, that's not going to be eating into your take-home, pay, which is going to impact on, with inflation, your ability to spend and buy the necessities that you need. So in other words, it's going to provide some cost of living relief. Now, on the flip side, though, what it won't do is create, as a result, arguably inflationary pressure, because the government's not necessarily coming in and spending a whole lot, right? What they're trying to do is simply just delay when you start paying that. Now, of course, the argument is, it will produce an increase to sort of, the real income in terms of what or I should say not the real income, the disposable income, right, of what people with help debt, who are in that bracket that will be extended in terms of that income threshold will be able to have. That may create some small amount of inflationary pressure, and that may be some of the little criticism that comes through as well. But this is something that's just happened, super relevant for each of you, who are intending to, I'm sure, go to university, and something that will have some interesting ramifications, both around cost of living, right, and support for lower income earners, but on the flip side, whether or not it creates some inflationary pressure. So there we have it, a big update, all things inflation. And hopefully it gives you a number of things that you can utilize on how to analyze the effectiveness of the current inflation data when you get to those essays for the HSC Eco course. I'll see you next week.